Now in Chapter 13, we're going to talk about preparing the statement of cash flows using the indirect method. As I said earlier in the presentation slides, that the main difference between the indirect method and the direct method is the operating activities section. So with the direct method, we have cash flows, positive cash flows, and negative cash flows, where we had that we received money from customers and we paid money out to suppliers. In the indirect method, we start with the net income, and then we adjust the net income based on things that happen in our daily operations. So we're going to look at our current assets and current liabilities. So that's exactly the same between the two methods. But the operating section looks at the changes in between the current liabilities and the current asset accounts. We're also going to deal with non-cash amounts like depreciation and amortization expenses. So we start with the net income, and then we adjust for non-cash expenses. So those non-cash expenses are depreciation, amortization, etc. Then we're going to adjust for timing differences. Our timing differences end up in our accrual accounts. Remember, our accrual accounts are salaries payable, taxes payable, accounts payable, prepaid expenses, accounts receivable, etc. And then we're going to adjust for any gains or losses that we have. We're going to look at our current assets and our current liabilities account. So if we have an increase from one year to the next in our current assets, we're going to subtract that amount. And if it's a decrease, we're going to add that amount. It's the opposite for the liabilities account. This is another slide that is just nice to have on hand as a good reference to help you remember if you're going to add or subtract from your net income when you're doing the indirect method for the statement of cash flows. This is a summary of what we look at when we're doing it. So we start with our net income. We're going to add depreciation expense. We're going to add if we have a decrease in accounts receivable. Or if you see in the deduct line, we're going to increase if we have a change in accounts receivable. We're going to practice this in our examples. So we have this information. We have an income statement and some information about our balance sheet accounts for this company. We're going to prepare our operating section. We're only going to look at the operating activities because that's the only thing that changes between the direct and the indirect method. So for the indirect method, we start with net income. And then we make adjustments. The first one we're going to do is our depreciation. So we add depreciation to net income because depreciation is a non-cash expense. We add back any non-cash expenses. And then we're going to look at increases and decreases in our current assets and liabilities. So we have our current assets and our liabilities. So we'll start with accounts receivable. We have an increase in accounts receivable. We went from 10 to 12. So increase accounts receivable. We are going to subtract that. Next, we look at our inventory account. We have a decrease in our inventory account. Last year it was 9 and this year 6. Decrease inventory. That difference is 3. The next account we have is accounts payable. So we see that we went from 11 to 7. That's a decrease in accounts payable. So why does accounts payable decrease? We have to think about this in a cash flows thing. Same with our accounts receivable and our inventory. So with our accounts receivable, if that increases, that means our customers didn't give us that money. So we need to reduce that from our amount of cash on hand. We have a decrease in accounts payable. So we're going to subtract that. We have an increase in salaries payable of 5 and an increase in interest payable of 1. We make all of those adjustments and we get our net cash provided by operating activities is 33. We can also make cash budgets. So cash budgets show us when we might have future cash shortages. So what a cash budget looks at is we forecast when our sales are, how much cash we normally receive from sales versus how much we get from accounts receivable. And then we also look at our cash payments. When do we sell merchandise? When do we buy merchandise? How often do we pay our employees? How much do we pay our employees? And we put all of that information together into a cash budget so we can see if there are future months when we might be short or ahead. So why do we want to look at our statement of cash flows and make sure that we're paying attention to our statement of cash flows? One of the reasons is because this is a very important financial statement. Some financial analysts will tell you that this is the single most important financial statement, that knowing how a company manages its cash tells you more about the liquidity of that company and how well that company is doing than anything on their balance sheet or income statement says. So we might want to always have really good cash flows because our creditors want to know that we're able to make our minimum interest and receive our payables payments. They aren't going to lend us money if it looks like we have cash flow issues. We can also, when we look at short-term versus long-term, it's very easy to improve short-term results, but that can be at the expense of any long-term growth. We can, for example, reduce spending on new products in order to increase our cash flows. So if we're researching on new products, we don't have those products out in the marketplace yet, so we're not selling them. We're just doing research and analysis. Right now they're just costing us money, which gives a negative impact on our statement of cash flows. So if we reduce the money that we're spending on that, it improves our cash flows for that accounting period, but that might mean that we don't release a new product, or it takes us a really long time to release a new product. Maybe somebody releases that product before us, and then they make all of the positive cash inflows on it than we were going to. That's an example of how we can do short-term things to cut expenses, but that impact our company in the long run. Other things that we can do to boost cash flows is to collect our receivables more quickly. So when we talk about receivables, if you remember back to those chapters when we looked at having credit terms that give people a discount for paying early helps us to receive money or cash for our receivables faster, which improves our cash flows. So companies will often look at how long it's taking their customers to pay them back in the receivables and then adjust their credit terms to encourage quicker payment. Other things that we can do are reduce the amount of inventory that we carry at any given time. Inventory is expensive to house, and we can, by paying for it more often, we reduce the amount of payments that go out at any given time rather than buying a bunch in bulk and then storing it. So there are ways that we can adjust our management of inventory to increase cash flows. We just want to make sure that when we're doing that with our inventory, that we don't lead to running out of stuff that our customers want. Other things that we can do to improve cash flow in both the short and long run, one thing we can do is deferring our income taxes. There are a lot of income tax strategies that we can use actually as both individuals and as companies to avoid paying income taxes. Now, you can legally avoid paying income taxes. If you think of things like how you get deductions through charitable contributions, that's a legal way to defer income taxes. There are, of course, illegal ways to defer income taxes, so you want to be careful. Peak pricing is another way. What peak pricing does is you increase the price when there's increased demand for it. For example, you think of hotels. Hotels have different pricing Monday through Thursday for their rooms than they do on Friday and Saturday nights. This is because there's a higher demand on weekends for hotel rooms than there is during the week. And then the third thing is an effective product mix. By selling products that complement each other, if you look at your economics terms, when we look at products that complement each other so people are more likely to purchase them together, we can increase the amount of cash flows that we receive from not just one product, but multiple products.